Hi guys. Hi Henry here. I thought I'd give you a market update as of the 5th of June 2023. It's been quite a crazy week in terms of the market. We've seen Chinese equities on Thursday dip by about 4%, the Hang Seng, and then on Friday go back up. We've had a lot of optimism with the US reaching conclusion and finally on the debt ceiling. And it was always likely, but it's confirmed. That's gave a bit more optimism into the US markets. And then finally, we can't go a conversation without talking about AI. And as you've got on your screen now, NVIDIA Corporation that's had an absolutely fantastic few weeks with profit expectations, etc. And that's brought the stock optimism into the S&P and the mega cap stocks once again, the Microsofts, the Alphabets of this world, and also into the other chip makers, TSMC being some other ones, Broadham being some of the beneficiaries of this kind of rally from NVIDIA and AI. So I want to go over a bit today about, in this week's market roundup, is where to see value, where we're particularly looking in a portfolio right now for one of the risk adverse, and also a bit more on the riskier side. So I just want to go over a few stocks, might be helpful for you, and then a few indexes that we've seen. As again, the end of last week, we've also seen the Japanese, the Nikkei 225, hit the highest it has done for the last 30 years. Again, I see this more of a sentiment that investors are looking as a very developed market outside of the US, as they see it as potentially quite high. They see Europe as a bit kind of conflicting right now with what's going on. So therefore, I think the consensus is looking for Japan. Again, it's beneficiary of some Chinese tourism reopening. A lot of actually internal investors in Japan are actually looking out and selling out right now. And a lot of foreign investors are buying in, particularly Warren Buffett, etc. Again, I do think this is a bit of an artificial kind of hiking up. It's had things in its favor, such as the weak yen, a lot of the international firms, and dollar that can transverse it. But it has been somewhat value for some time. And again, I think it's coming more towards parity in where it should be, rather than kind of growth markets in that area. So then we're looking at stocks as of there. We're looking at particularly for investors and where to get kind of earnings. OCBC Bank, so Singapore Bank, it's got a large market cap. We see this as a great potential. Again, if you look at this from simply Wall Street, it's trading at 42% of what they believe is their fair value. It also has a good dividend as well, around 5%. It's in great health. And also what you may see from the knock-on effect from the Swiss banks, Finasco, is that more people are looking towards Asia, particularly Singapore as a wealth management hub. They're moving their money from Europe, the old safe haven of Switzerland, to more the new one, where growth's going to be over the next 50 years, and that's Singapore, OCBC. It's government-backed as well. It's just a good kind of stable stock, not a growth stock with any banks. Good for dividend, bit of stability, and showing a bit of value in good health. Not a bad option. The next one we go to is US stocks. Now, again, a lot of you say US stocks, you think of kind of the growth companies. I think they still have a bit of potential growth in them, but again, from what I say, some analysts may disagree. They're looking at the forward earnings and saying they're still a good buy. I think they're actually, you really are paying a premium for them now, and they're not as scream as what they were last year when we bought Meta, for example, at 99. It's gone up over 100%. Google's gone up 36 since we got in. They're not screaming buy right now. Again, I wouldn't go against anyone for holding them. Right now, I do think they do still have a competitive advantage, and people are looking at the forward earnings. Again, not just the PE ratio may have a valid reason for still getting in, but for us, see more kind of opportunity in ones that are out of favor, trading a low PE ratio and have something of a bit of a low beta. So, for example, we've been looking at Pfizer. So again, a quick overshot from simply Wall Street. The profit margins around 32%. It's got a P ratio of 7%. And actually, if we go to Yahoo Finance, we look at the gross profit is actually increasing. Again, it may not likely to continue as of this year, but we go down, you can see the gross profit has actually increased significantly. So we think that's actually present value, as well as that it gets a good dividend of 4.28% in good health as well. So again, for those more looking in the US, a developed market, a kind of blue chip name that's showing more value, we believe this is the one right now. Going on to the more growth end of the stock, it looks a bit less kind of incentive to buy than what it did a week ago. It's the current market value gone up kind of 4% in this week, but still believe in the long-term consumer discretionary in China. And Alibaba stock, yes, it is at a high PE ratio, but I think it's got the macro tailwind there, just in China and also in the region as well. Again, believe it's quite a good health company. It's been kind of beaten up as recently through regulations from the Chinese government. But again, just have a look at some of this again from simply Wall Street, 18 below, and this is in good agreement. It's got good health. Dividend, you're not buying this as a dividend stock. It's a growth stock for that. So again, this is what I'd be personally looking at for growth. It's an alternative to the US growth stock as well. That more on the hold side on that. Maybe completely wrong, but just see more value. And finally, we've got another pharmaceutical, quite into pharmaceuticals right now, as they are. I just think they're a good business model. They can have a good profit margin. Yes, they've had new legislations that have come in from the US saying they've got to innovate. But again, if they do their job properly, I don't think they have anything to worry about in that. And a lot of the big pharmaceutical companies, they do have the money, they do have the resources, they do have the talent to innovate. So I don't think it's too much of a problem. And again, a lot of these are trading at what analysts expect at fair value. They're paying good dividends and they're in good health as well. Roche is just another one of this. And if we can click here, again, gross profit margin increasing slightly, but it's still pretty reliable. Again, if you're going to get the dividend, I think it's a good option as to a hold on a company like Roche. So that's the market and where we're looking over the next month or so as we come into the summer break. We do think there are some opportunities out there. Again, if you're looking to what might happen in the future and the turmoil, would look a bit more defensive than growth orientated. Again, maybe a bit of outlandish saying that when you've seen the video go up 40%. We do believe that there is some good value stocks out there that have a large market cap and are not going out of line with a lot of blue chips, so we say on that. So we hope you found that useful, and you can actually add this to your portfolio. Again, with anything in investing, it does contain risks. This is not specific financial advice, and all of this is my own opinions. Thanks for listening, guys. Enjoy investing.